Hello and welcome. This is Professor Svark, and in this video I'm going to provide you with the information to complete Chapter 6A homework. The first thing that I want to do is to review the inventory formula. Recall that beginning inventory plus purchases gives us what we have available for sale. So inventory available for sale. Out of that, there's only two things that can happen to our inventory. Either they're sold or they're left in ending inventory. And so these last two pieces are interchangeable. We can either subtract ending inventory to equal cost of goods sold, or we could have subtracted cost of goods sold here to equal ending inventory. Okay, so either direction that works. And really, the whole idea is that our beginning inventory plus purchases has to equal what we have in ending inventory and what's available for sale. These two have to equal, right? And as I said last week, think of this as shoes in the closet. If you had 10 pairs of shoes in the closet and during the month you purchased 5 more, right? At any given point in time during the month, you would have had 15 pairs of shoes. But if we open our closet now and we only have 12 pairs, right, that means we must have given up 3 pairs. So perhaps we sold 3 pairs or we donated 3 pairs, right? Because of these 15 pairs of shoes that we need to account for, they're either still in our closet or we've gotten rid of them, we've sold them. All right. The last thing I want to say about this inventory formula is that we can use it for both units and dollars, and we'll do both today. All right, so today's lesson is going to basically turn away from journal entries and focus on the cost per unit of inventory, right? So last week was all about journal entries that accumulated the total cost of inventory. Now we're saying, okay, let's break that down into a per unit inventory cost. And in particular, what we're looking at is when our costs and our costs in our inventory available for sale vary, even though we're dealing with the same product. Okay, so let me just take, for example, cans of soup, right? So if we're a small store and we've got cans of soup, right, and these are all the exact same cans of soup, and we purchase them for $1, okay, and maybe we're going to sell them. Our selling price is, I'm going to just say $5. Okay, so we've got 3 cans of soup. If a customer comes in and buys a can of soup, we know that our selling price is $5 and our inventory and cost of goods sold adjustment is going to be for $1. But what if during the period we bought more cans of soup and our vendor, I'm not a very good artist here, and our vendor increase the price on us, right? So now it's $2. Our cost, these are our costs, is $2. So now when a customer comes in and buys the soup, right, and these are all exactly identical labels, identical barcodes, now we know the selling price is still $5, but what's our cost that we want to take out of our ending inventory? $1 or $2. And there's a variety of ways that we can do this. The first is specific identification. Specific identification says, hey, we know exactly which can our customer came in and bought, right? Our customer bought this $2 cost soup, okay? But that's not practical when we're talking about large volumes of sales. It is practical when you're talking about specific industries. It works very well for vehicle sales. It works very well for high dollar items like homes, jewelry, right? We know exactly how much each item costs, okay? And we know exactly which item sold. But when you walk into a supermarket and you see all the cans of soup, that's not practical, right? even if you think about milk jugs with expiration dates, even though they're going to try to push those old milk jugs to the front, nobody is back there policing that, right? Nobody's back there saying you have to take the oldest ones, and they're not looking at the expiration when they scan the item, right? They're only looking at the barcode, which is identical. Every single one of these items has the same barcode. All right, so what's another method? Because we've got this dilemma and we need to figure it out. Well, the most common one is called first in, first out, or FIFO. What this means, and again, this is an accounting assumption. It's not what's really happening. Well, and I'm going to take it off of the specific identification. So the rest of these items, or the rest of these techniques that I'm going to show you, are accounting assumptions, meaning this is just how we're going to organize our costs. It doesn't mean what's really happening. The first in, first out method says, hey, the first item that you bought is the first one that you sell. So in this example, our cost would be $1. Okay, same selling price, $5, but we would take the older inventory out first. First one in is the first one out. Okay, and again, that's a pretty easy method, so that's why it's the most commonly used. It also kind of goes with the flow, because when we buy inventory, right, we're hoping it sells. We're not buying it to stockpile inventory. We're hoping as we replenish inventory, what we're doing is we're pushing the old inventory out and replenishing it, right? So first in, first out feels natural. The opposite of first in, first out is last in, first out, or LIFO. And that's the exact opposite. That means we would assume the last item in would be the first item we sell. So our cost in this case would be $2. Okay? And we'll talk about why people sometimes use that method in a little bit. And the fourth method is weighted average. And a weighted average method is not just an average, right? An average of these costs would be 150, right? We would take 1 and 2 would equal 3, and we divide by 2. This is a weighted average, meaning it's going to weight our average based on how many units we have in $1 amount versus other dollar amounts. So in this case, we have more items at $1, so our average would be closer to 1 than it would be to 2. So in this case, I don't know. I'm going to guess that the average would be somewhere around $1.25. Okay, and we could prove that out real fast, but I don't even need to. All right. So those are the four inventory assumptions that we use when we have more than one cost in our inventory. So let's see how this really works. And let me skip this rules of ownership. We'll come back to that later. All right, so how does this really work? Here's an example. During the first month of operations, McLaney Company made 3 purchases of merchandise in the following sequence: 300 units at $6, 400 units at $8, and 500 units at $9. Okay. Assuming there are 200 units on hand at the end of the period, compute the cost of the ending inventory. All right, well, we know there's 200 units left, so how many units were sold? That's where our inventory formula is going to come in handy. So this total is $1,200 units, and we could go ahead and multiply these out as well. So this is 1,800, this is 3,200, and this is 9 times 5 is 4,500. So that means we've got a total dollar value of $9,500 in inventory available for sale. Okay, so during the month, the units available is $1,200 and $9,500. All right, so 200 units are an ending inventory. That means, That means, that means that 1,000 units must have sold. Right? If we've got 1,200 units available, 200 are left in ending inventory. Let me again point out where I got this information. Then that means the remaining 1,000 must be sold. So let's go ahead and first start with the FIFO method. And this is using, everything we're going to do today is using the periodic inventory system. The periodic inventory system means that we pull inventory out, right? We reduce inventory on the financial statements, right? Costs at the end of the period. So therefore, these 200 units left, right? This was at the end of the month. That means during the month, okay, and I'm thinking it's the month, right? It doesn't really say, it just says, oh yeah, first month. So during the month, 1,000 units sold. And we don't care when those sold because we're just going to pull those out of inventory at the end of the month. So using the FIFO method, we're going to sell the first ones in are the first ones out. So I have a real easy way to organize this data. We're going to make our sales arrow fall. And remember, this is FIFO. So the sales arrow falls for FIFO. That means we're going to compute our sold items first, and we're going to pull them from the top down. So we know we sold 1,000 units. So starting from the top down, we know we sold all 300 units at $6. We know we sold all 400 units at $7, or I'm sorry, at $8. And that gives us 700, but we only need 1,000 units. So we only need 300 of the 500 in the last tier, right? Because what I'm trying to do is I'm trying to get to 1,000 units here. We know 1,000 units sold, so I'm trying to pull from the top down 1,000 units. So 300 sold at $9. So therefore, our total 1,000 units that were sold, we're going to pull out of inventory with a cost of $7,700. Then the question becomes, what's in ending inventory? Well, it's what's left. And right now we have none in the first two tiers, right? We sold them. So we had 300 units, we sold all 300. We had 400 units, we sold all 400 units. But of these 500 units, we sold 300. So that means 200 units are in ending inventory with a cost of $9. Okay, so our total ending inventory is $1,800. And we can confirm our math by taking the cost sold plus the cost in ending inventory and confirm that it equals $9,500, which is our goods available for sale. All right. So I'm going to show you this again, okay, using the LIFO method. And it's going to be the very similar technique. And if this feels a little uncomfortable right now, it's okay. Once you grasp this idea, once you hear it a couple of times, it's going to sink in. But it just takes just a little bit. All right. So let's do the same problem, right? We've still got McLaney Company, but now we're going to use LIFO, last in, first out. So remember that we had 3 purchases in the following order. 300 units at $6, 500 units, I'm sorry, wrong, 400 units at $8, and 500 units at $9. Okay, and those still equal up to 9,500 and 1,200 units available for sale. We still have 200 units in ending inventory. So to figure out what sold, we can take ending inventory, subtract that from what's available for sale, and we know we sold 1,000 units. So the question becomes, what units did we sell? Right? We don't care what physically came off the shelf, but in our accounting records, we need to have a systematic process to figure out which units do we take out of inventory. So here's my trick for you, the LIFO arrow lifts. So our LIFO sales arrow lifts. So when we're pulling our 1,000 units that sold, we're going to go from the bottom up. So all 500 units at $9 sold. Oops, 4,500. All 400 units at $8 sold. And that gives us 900. What we're looking for is 1,000 units. So now I'm going to pull 100 units, the remaining 100, at $6. Okay. And that gives me my total, 1,000 units. And I can go ahead and total that. I get 8,300. And then we need to figure out what's left. So remember, we sold from the bottom up. So all 500 units from the bottom sold. All 400 units from the middle tier sold. But from the top tier, 300 units were there and we sold 100. So our ending inventory is what's left. What didn't sell? So we have 200 units at $6 or 1,200 total dollars. So this is what's sold, and remember, it sold from the bottom up. So we have 200 units at $1,200, and if we total, we've got 1,200 units accounted for, and we've got $9,500 total. That's 8,300 plus 1,200 equals 9,500, which again equals what we had available for sale. All right. So remember, the FIFO sales arrow falls and the LIFO sales arrow lifts. If you want to, go ahead and try one on your own. Let me set it up for you. So here we've got a company, Easy Slide. It's a snowboard sales company. We have inventory plus purchases. And we sold, so this time we know how many we sold, but we don't know what we have in ending, we do know what we have in ending inventory. No, not in this one. We don't. All right, so let's look at our inventory formula, right? I like to always start with that. So this is what's available. Okay, so they did give us our totals available. We know we sold 102. So that means we have 25 units in ending inventory. All right, so starting with FIFO, right? So why don't you guys pause and just start with FIFO, then come back and we'll work on LIFO. All right, so remember, under FIFO, our arrow falls. So if we sold 102, we need to go ahead and pick the first 102 units here. So we have 12 units at $100. We're going to go ahead and pull all 45 units at 103. But then the question is going to be, how many more units do we need? Okay, so we've got, what is that, 57. We know that we need to come up with 45 more because, again, our goal is to equal 102 sold. So I need 45 more units that I'm going to pull from this third tier here. So 45 at 104. And that's going to give me 4,680, or a total of 10,480. $515. And we could add these up and it would be 102 units. All right, so cost of goods sold is $10,515. The other question then is what's left? What's in ending inventory? So again, just go through kind of step by step, right? We sold all the first 12 units, all the second 45 units. Of the 50 units in the third row, we sold 45. So we have 5 units left at 104, which is 520. And we have all the bottom units here, 20 at 105, which is 210. So we know we have 2620, so again 25 units, and 2620 in ending inventory. And again, we would want to check our math to say, okay, 10,000 plus 515 plus 2620 does indeed equal $13,135, what's available for sale. All right, if you got this, go ahead and pause the video and do it again. This time, we're going to go ahead and use LIFO. Same concept, go ahead and set it up, right? But remember that the LIFO sales arrow lifts. All right, so now we're going to go ahead and start with our sales from the bottom up. We know that we sold 20 at 105, and we're going up now. We're going to sell all 50 at 104 because that'll give us 70 units. Okay, but then how many more units do we need to equal 103? Well, we've got 70. I'm sorry, it's 102. We've got 70, so we need 32 more units at 103. All right, so I'm only taking 32 of the 45 units here. And we don't need any from the top because that would solve all of our sales, 102 units. Okay, so that total equals $10,596. Then we want to figure out what's left in ending inventory. Okay. Well, it's what's left. So remember, we sold all 20 units at the bottom, all 50 units, and then out of the 45 units, we sold 32. So we know that we have 12 units on the top, and we've got 13 units, right? 45 less 32 is 13 units at 103. So when we add up our ending inventory, we've got our 25 units at 2539. Okay, and again, we would check our math here to say, all right, cost of goods sold, $10,596 plus ending inventory, $25.39, should equal goods available for sale, $13,135. All right, so that's LIFO. The sales arrow lifts, meaning we pull the sales out from the bottom up. Now we have one more method to discover that I'm going to walk through, and it's the average cost method. So remember, this is a weighted average. Now it's a real easy one to do. We still need to figure out how much units were sold and what we have left in ending inventory. Okay, but what we're going to do is we're going to take the total dollars over total units. So this is available for sale, right? At this available for sale level. Sometimes you have to compute that, but this would be our 13,135 divided by 127 units. And we end up with $103.426. And it says to round to 3 decimal places, which is pretty consistent with your homework. Now, what I will say with your homework is once you get your average, clear your calculator and go ahead and punch in this amount going forward. So you'll end up with, some additional numbers here. If you just start to multiply, which I think is a habit, we all are used to, is saying, okay, well, whatever's in my calculator times 102 units, but that will give you the wrong answer. So you want to clear your calculator and then use your answer with only 3 decimal places. So to figure out cost of goods sold, you take your units sold, 102 times 103.426. And that gives us 10,549.452. Ending inventory would just be the number of units, 25, times this new average cost. And that would be 2585.65. And if we add these up, we're pretty darn close to 13,135. Oops, not that one. Sorry, I just grabbed the wrong. If we add up cost of goods sold plus ending inventory, we're real close to 13,135. It's off just a smidge for rounding, and that's okay. All right, so those are the 3 methods you need to know for the periodic method. Okay, and again, this weighted average, if we look here, the cost ended up being, kind of in the middle here because the weighting, we were pretty evenly distributed here. But if we had mostly if we had 200 units, let me pretend that if we had 200 units at 105, right? See how that would make it so many units at 105? That means that our average would be closer to 105 than it would be 100. Okay, that's why it's the weighted average. Okay, it's not 12 plus 45 plus 50 plus 20 divided by 4. That would be just a standard average. This is a weighted average. We're taking our total dollars, right, divided by our total units. All right. So now we have another example. So we're going to go through 2 more. If you're still struggling, go ahead and just watch me. But this would be a great time for you guys just to attempt the problem, right? I'll set you up and then attempt the problem, FIFO, LIFO, and average cost. Because at least if you attempt it and you get stuck somewhere, you know where you got stuck and you know where to listen as I go forward. All right. So this is Jeter's company has the following inventory for June. Right, so we've got inventory plus 2 purchases, and we have the end of the month. That's our ending inventory. So this right here is our ending inventory. So what we need to do is figure out how much inventory do we have available for sale. So if we add up 120, 370, and 200, we get 690 available. Okay, 230 is our ending inventory, so that means 460 units were sold, right? Think shoes in the closet. If we had 690 shoes and 230 are left, that means we got rid of 460, okay, which would be a lot of shoes. All right, so let's go ahead and start with FIFO, okay? So under FIFO, remember our sales arrow falls. So we're always going to start with sales, and then we'll capture ending inventory or what's left. Okay, so we sold 460. So starting from the top down, we want to compute 460 units. So we know we're going to sell all 120 units at $5. But then the question becomes, how many more units do I need to equal 460? Okay, I don't need all 370. Then I would have taken out too many units. So what we need is 340 more units, right? Because that will total 460. So 320 of these 370 units at 6. Okay, which is 2,040. And we can go ahead and total up, 2640. Okay, and then we can ask what's left. Well, we sold all of these inventory. We sold some of the units at 6. So we have 30 units at 6. Okay, and then we still have all 200 units at 7. So when we total that up, we get 1580. And again, we can take cost of goods sold plus ending inventory, add them together, and we get, well, we didn't actually ever total, 4220. We do get $220. Okay, and this is cost of goods sold and ending inventory. All right, so let's do that again using LIFO. Okay, so remember under LIFO, and let me pause, right? If you want to pause the video and try it on your own, go ahead. All right, under LIFO, your sales arrow lifts. So we first need to get all of our totals. We still have 690 units available. 230 are left, so we know 460 units sold. It's ending inventory. Okay, we're going to sell those 460 units from the bottom up. And this is still $4,220. All right, so here we're going to sell all 200 units at 7. Okay, and then we need to figure out, well, how many of these 370? If we put 370 here, that would mean that we sold 570. So we don't want to do that. We only need 460. So we would need 260 at 6. Okay, so 260 at 6 is 1560. And that means that we've got 2960. And then we need to figure out what's left in ending inventory. Okay, so here we sold all 200 units. If we look at our 370 units, we sold 260. So that means we have 120 units at $6. And we have all 120 units at 5. You know what? I think I made an error here. Sorry. Let me redo this here. So we have all 120 units at 5. But of these 370, we sold 260, which leaves us with 110 at 6. Or 660. Ah, that looks better. So now we have 1,260. And what I just demonstrated to you is why it's always nice to check your work and confirm that 2960 plus 1260 does equal 4220. Because if we did not get that confirmation, we would have known that we picked up a wrong number, which with this many numbers and this much addition, it's very easy to pick up a wrong number. So again, first we're figuring out cost of goods sold. Next we're figuring out what's left, and that's ending inventory. All right, the last one that I want to do is our average cost. And again, you can pause and figure this out on your own, or you can just follow along with me. Okay, so remember our average is total dollars available for sale over total units available. So here we had to do the computation. So we've got 4220 divided by 690 units. And that gives us $6.116, I believe. Okay, that becomes our new cost. So when we figure out cost of goods sold, what was sold? Well, we sold 460 units times 6.116. Okay, and that gives us 2813.36. And ending inventory, what's left, equals 230 units times 6.116. And that equals $1,406.68. Okay, and the total of those two is $4,220.04. So again, we're really close. This little bit of difference is rounding. All right. So the question becomes then, which costing method gives you the highest ending inventory, right? So if our costs are rising, right, which one leaves us with the highest dollar in ending inventory? So look at your sheet, and it's going to be LIFO. No, I'm sorry. I take that back. Highest ending inventory means it's going to be FIFO. Let's go back. FIFO is going to have the highest ending inventory because it's leaving us with more units at higher dollars, right? We sell from the top down, so that means what's left in ending inventory over here is the higher dollars. Okay. Oops. So in this case, what's the highest cost in ending inventory? It's going to be FIFO. What about the highest cost of goods sold? Which one gives us the highest cost of goods sold? Well, that's going to be LIFO because we're selling from the bottom up. So that means our higher dollars are going to be cost of goods sold, which results in lower net income. Okay. So highest cost of goods sold is LIFO, which again means less net income. Okay. And average cost, if you look at the actual dollars on your sheet, it's right in between. It kind of evens everything out. Okay, so most companies use FIFO, okay, because it makes sense. Some companies use LIFO, and it's typically a tax strategy because you end up with higher cost of goods sold, which remember is an expense, and therefore lower net income. And average seems like it would make sense until you think about all the moving pieces when you go to Walmart, right? Think about all that inventory and think about how much calculations went into this one little bit of average cost. So that just creates a lot of additional calculations, which could create more risk of error. And the last question says, why is average cost not $6, right? Right in the middle, 5, 6, 7. Why do we not have an average cost of 6? Well, it's because the average is weighted. So $6 is right in the middle. I have more units at 7 than I do at 5. So that pulls, right? The weighted average pulls the average more towards the costs that have more units. So that's why, and really our most units are in 6. But then we still have more units in 7 than we do 5. So that's why it's pulling more towards the higher amount. All right. So the last problem on your worksheet is a perpetual inventory system, and we're going to do that in our next session. So save your worksheet. We'll complete it in class. Where we're going to continue to talk about FIFO, LIFO, and weighted average, but we're just going to use a perpetual inventory system. And actually, let me just introduce you that a perpetual inventory system means that we reduce inventory in our accounting system with every sale. And recall that that's a little different from periodic. Periodic reduces inventory just at the end of the period, right? Perpetual means you're perpetually reducing inventory. With every sale, right, we're debiting cost of goods sold and crediting inventory, which is what we learned in the prior chapter. So this is a perpetual inventory system that we learned. Okay, so now we're going to learn how to associate the cost per unit to match that system. Okay, but for now in your homework, you will be focused on FIFO, LIFO, and weighted average. And remember, right, your FIFO sales arrow falls, your LIFO sales arrow lifts, and your average is total costs available over total units available. Okay, so with these arrows, go ahead and actually for all three methods, you really need to figure out how many units were sold and how many units are in ending inventory. And for FIFO and LIFO, we're going to just go ahead and use the arrows to steer which direction we're pulling inventory. So this should get you through your homework for 5A. If you have any questions, of course, I'm always available. I'm just an email away. Thanks and have a great day.